We have Bloomberg calling the AI market to be a 1.3 trillion one by 2032. That is an average increase of 42% over the next 10 years, year on year. In fact, PwC call this industry a 15.7 trillion game changer. And when we take a look at the S&P just yesterday, Nvidia is down around 3%. Now, you could argue this is a company that is taking a breather. Year to date alone, it is up 155%. Over the last 10 years, up more than 27,000%. And for a company with still a strong buy from Wall Street, today's episode we will be focusing on 4 other AI stocks that we do believe will be very strong in the future. And as we can see, all of these that we will run through today will have buy ratings, and we'll run through each one. We're going to look at their underlying metrics, talk about what we like from them, their free cash flows, their sales growth, as well as other metrics, and we'll run every single one into our valuation model. We want to get to our own intrinsic value. We want to get to our own acceptable buy price, given our investor margin of safety, and we'll also look towards Wall Street to see what they're forecasting over the next 12 months. And for each one, we will run it through the valuation model. You're going to see 3 different rates, a low, medium, and high. So not only will you be able to understand where our price targets are coming from, but you will also be able to have and see what your own price targets will be, so you can have your estimations on whether or not you do believe these companies will grow rapidly over the longer term. So the first one we'll look at is SMCI Supermicro Computers. We already get a double buy rating with a strong buy from Quant. It is trading in the mid to upper end of the 52-week range with a forward P that is sitting around 38.06, lower currently than Nvidia, and just over the last 12 months it is up around 312%. If you've been a shareholder over longer term, you would be up on a 10-year basis 3,602%. Now, on top of this episode, other than just looking at the metrics, we're also going to have a quick look at 2 ETFs, the SMH as well as SOXQ, for those that are interested in investing in an ETF as well as individual stock. Now, going back to Supermicro Computers, as always, we do focus on the free cash flow, as earnings data can be susceptible to manipulation by management through accounting. On the free cash flow, what we do note with this company, it has been very inconsistent year on year. Some very strong free cash flow metrics like the last full year in 2023, but also we do note some years where it was negative. You could argue there is some cyclicality with this industry. In terms of the sales growth, well, whilst we want to see 3 to 7% year on year, what we noticed with SMCI, nearly double-digit growth year on year, 37% in the last full year, 80% on a trailing 12-month basis, so that does look to be very strong. And numerically speaking, they have increased their top line rapidly, 1.5 billion in 2014, 7.12 in 2023. One thing we love to see with companies is when they do share buybacks, returning excess cash to investor pockets, essentially giving you a larger portion of control of the company. What we do see here is, in fact, they would have diluted your position over the longer term. 2 things to note. First one, it is fairly trivial, not a large amount. Second thing as well, you probably wouldn't care as a shareholder given how rapid the share price has grown over the period. The other metric that we do quite like to look at is the ROIC, return on invested capital, 10% or more to give us faith management are able to effectively allocate their capital. 33% in the last full year, looking very strong, 16% as well on a trailing 12-month basis. Lots of attractive numbers for potential investors. In terms of operating margin, one area we would like to see them improve. We do ideally want to see a minimum of 16%. Nice to note though, 2023 was their strongest year at 11%. Hopefully they can continue this upwards trend from the lows of 2021. Free cash flow margin as well, what we can see the inconsistency, which did reflect when we did look at that free cash flow per share earlier above. Net debt to EBITDA then, the earnings before interest, tax, depreciation, amortization. As always, this does correlate to balance sheet strength. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 0 in 23, 0 over the next 12 months, meaning it won't even take SMCI 1 day to pay off all of their debt net of cash on hand. Now let's jump into the valuation model. As always, if you are enjoying the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now what we have here for the DCF model is the free cash flow year on year. Average growth skewed due to the fact that it has gone from years of negative to positive. Now forward looking, we've gone for 3 different growth rates, low, medium and high. Now we are starting off with 20% as a low rate moving forwards. With the discount rate, we get the present value of future free cash flows and terminal value add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we see we're getting to a signal here of overvaluation. Now bear in mind, this is the first rate we're looking at, and this would give implied downside of negative 19%. Now with the industry growing very rapidly, estimated over the next 10 years, for those who believe 20% is way too conservative, at 25% it would be giving a signal of undervaluation, and this would indicate implied upside of 13%. Again, a lot of people may be saying 25 is still too conservative. At 30%, the intrinsic value of $1,422 would give a high upside of 57%. But as always, bear in mind this is subjective. You can always click on the pinned comment below, grab a copy of this model, run your own numbers through to get your own believed intrinsic value. Now, we're going to take towards the next slide the middle rate of 25%, which does give an intrinsic value of just over $1,000. And typically on the channel, we do have 4 different models that we use. SMCI, we only believe the DCF model to be relevant, and that is therefore the calculated intrinsic value in today's episode. As always then, we do use a margin of safety of 10%, which we execute on if it meets our 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for SMCI, well, it is a buy up to $922. Then we keep going till it's near the current trading price. Now it's not at $871 yet, so today's episode we do see around 10% in terms of MOS level. Whether or not you do believe that is a buy right now, remember that is solely subjective on the growth rate moving forwards of 25%. In terms of Wall Street and their estimations, well, over the next 12 months, they believe the share price will go higher than our calculated intrinsic value, and they see upside of 18%. As always though, let us know your thoughts with these stocks as we do run through them today. We then move on to AMD Advanced Micro Devices, a double buy rating with a hold from Quant. It is trading right there in the midpoint of the 52-week range with a forward P that does sit just over 46, and over the last year it is up around 44%. Over the last 5 years, up 454, and over the last 10 years, a similarly very strong performance, up 3,825. Now, in terms of their free cash flow, well, we like to see this. It has gone from negative over 2014 to 2018 to positive, although a little bit too inconsistent. What we can see, there is a massive growth jump expected over the next 12 months to $3.51. In terms of sales growth, we do get that inconsistency that we mentioned, again, that cyclicality element, although we do know lots of years of very strong double-digit growth. We need to point out, though, the more recent year, 2023, they did have a negative 4% drop, and as we can see, around 4 times growth over the last 10 years. Similar to SMCI, they would have diluted your position over the last 10 years, but as we said, with the share price growing in the thousands percentages, you wouldn't really care. ROIC then, very, very inconsistent, a minimum of 10%, which they have got a majority of the last 10 years, but unfortunately the last 2 at 1 and 2% is a little bit something to consider. Maybe factor that into your margin of safety. Operating margin then, the majority of the years are looking fairly positive, although we do note from the highs of 2021 it has started to come down. Free cash flow margin at a bare minimum, we do want to see 5%, which we do get over the last few years, but again, there was that period from 2014 to 2018 where they were free cash flow negative. Net debt to EBITDA looking very strong from 2019, similar to SMCI, not even one day in 2023 or expected the next 12 months for them to pay off all of their debt net of cash on hand. So let's get it to the intrinsic value. Now, the DCF model for AMD, we have the free cash flow year on year, again, similarly a low forward rate of 20%. With that discount rate, we are getting an intrinsic value here of $106. So that essentially implies around negative 34% upside if you do believe that their free cash flow over the foreseeable future will grow 20%. For those that believe 25%, well, we can see intrinsic value showing overvaluation, $142. And for those that believe that is way too conservative for the company as well as the industry, at 30%, we do see undervaluation, but it is sitting around the 18% level. Now, to be consistent, we will go with the medium rates throughout today's episode. So at that 25% level, when we do take a look at AMD, what we do get to see is that it is trading in terms of what we believe to be at a premium, as the current price is $161. For those that are looking for a 10% margin of safety, though, you would be looking to buy around $128. And in terms of Wall Street, well, they don't agree with us. They essentially see upside of 19%. Their price target is $192, and effectively what they are saying is, as we can see, they believe the growth rate should be at 30%. Now, it really does come down to what you believe. So if you are someone that says, you know what, 30% should be the right number, then essentially what we can see here in terms of a margin of safety, it would be sitting around 15%, indicating a buy alongside upside of 19 as well. As always, very subjective. You can grab a copy of the model below, but these are the numbers that we are looking at today. We then move on to ON Semiconductor, again a double buy rating with a hold from Quant. Interestingly, the first one that is trading right there towards its 52-week lows. It does have a forward P sitting around 17.11, one of the lowest in the industries, and it is down around 22% over the last 12 months. Over the last 10 years, however, up 654%, and we can see all-time highs around $106 last summer. In terms of the metrics, well, free cash flow actually looking very strong, around 10 times growth over the last 10 years. Granted, we do see some years where it does dip, but every single year after it has rebounded. Again, 2023 and beyond, it is expecting to have a small dip. And when we look at the sales growth again, cyclicality, 3 of the last 10 years are negative, last 2 years looking very strong, and on a trailing 12-month basis though, they are anticipating that growth to come down to low single digit, one of the reasons why we do see that share price down. Numerically though, they have nearly tripled their top line over the last 10 years, and whilst they would have diluted your position at some points throughout the year, the net position is a share buyback of around 2 million. Fairly trivial. ROIC actually looking pretty good over the longer term. Last 2 years, very, very strong. Trading 12-month basis as well. 24% is what we like to see on this channel. And operating margin, very strong. This is what we call operational efficiency, with the margins increasing from 9 to 33%. Free cash flow margin also looking good, consistently above those 5% levels that we want to see. And even after the dip over the last 12 months, 7% still looking okay. We then move on to the net debt to EBITDA. Unlike the first two that we have reviewed today, what we do notice is there are some numbers, 0.18, still very strong, trailing 12 month 0.33, and even over the next 12 months, signaling that ON Semiconductors does have a very good balance sheet. In terms of the valuation then, for the DCF model with our different rates, we do start off with that 20%, and what this indicates to us is an intrinsic value of $65, not too far off essentially the current trading price, although we do note downside of 5%. At 25% moving forwards, then we see an intrinsic value of $92, and as we can clearly see, upside 34%. Again, a lot of people will say that is too conservative. 30%, we do in fact see intrinsic value showing 88% upside. As we mentioned though, to be consistent, we will go with the medium rate today. So this effectively gives us an intrinsic value of $91.84, and when we do run it through the margin of safety, what we can see today, it is a buy with a 10% MOS, at 15% a buy, 20% again, still showing a nice margin of safety, pretty much bang on a 25%, which for this industry is very, very rare, as we have seen throughout the episodes on this channel. And in fact, we do see Wall Street indicating upside of 23%, a target of $84.43 over the year. As always, do give us your thoughts below. Now, before we move on to the final one, just to let you know, we have released our latest free weekly article. If you want access to any of these, all completely free, do click on that pinned comment below. For example, if you want to see the websites, the screeners that we use, again, you can click on this article. Or if you want to see 12 undervalued stocks that are of high quality, we do run through them and give our own opinion. The next one is ACLX, Axelexis Technologies, where we do have a very strong buy rating from Wall Street, 4.42 out of 5. Trading in the mid to lower end of the 52-week range with a forward P of 22.27. Over the last year, however, it is down 17%. Over the last 10 years, again, very strong, up 1,654. And we can see all-time highs around that $193 mark last summer. In terms of the free cash flow, well, growing over the longer term, but we do see dips as well as negative year on year. Again, best thing to do with these companies is buy them when they are out of favor and out of cycle. What we do notice on the sales growth, strong double-digit increases year on year for the majority of the last 10 years, and we can in fact see their top line has grown nearly 6 times over the period. While they would have diluted your position over the last 10 years, fairly trivial, and in fact, from 2021, they have started to do some small share buybacks year on year. ROIC looking very positive over the last 4 years as well, 28-29% over the last 2 years. This is exactly what we want to see on this channel. Operational efficiency, again on the margins, 23-24%, again looking very healthy if they can sustain this increase as well as these levels over the longer term. And free cash flow margin, as we always say, minimum of 5%, which is what we have seen over the last 4 years. In terms of net debt to EBITDA, nothing really more than you could want, 0 pretty much 9 of the last 10 years, and we can see expected over the next 12 months, Won't even take them 1 day to pay off all of that debt net of cash on hand. So in terms of the DCF model, we have gone for a lower rate with this company, given the fact that it is a smaller company than the other ones we have taken a look at. And what we do know, when we do use a 10% growth rate, we can in fact see the intrinsic value is showing undervaluation already on that low rate, therefore implying upside of 7%. We then move on to the next rate, which is 15%, and therefore this gives us an intrinsic value of $203, 48% upside. And when we do go down to that high rate of 20%, we are seeing more than double. So this could be a really strong stock if you do see it growing at around 20% on the free cash flows year on year. As we said again, for that consistency, we will take the medium rate. Therefore, the intrinsic value in today's episode is arriving at $203.60, which means there is some significant margin of safety with this company. And when we do run the numbers through, 10% is what we start off with, 183. Then we keep going to show you that there is a lot of MOS with this company if you do believe it over the longer term. Not quite at 35% just yet, sitting somewhere between 30 to 35%. In terms of Wall Street and their expectations, well, as we can already see, upside of 15%, their price target 159, so they do have a lower estimation where moving forward. We can see it is sitting somewhere between that 10 to 15% moving forward. As always though, do let us know your thoughts in the comments below. And now we'll quickly run through two ETFs in the semiconductor space to think about. We first have SMA. Now we have a buy rating and a strong buy rating. It is trading in the upper end of the 52-week range with a yield on a trailing 12-month of 0.39% and an expense ratio of 0.35. Now we do see it has performed very strongly just over the last year. It is up 77%. And when we take a look at their holdings, what we want to point out here is that not only is Nvidia the largest one, but it does sit around 25%. Now, when we compare this to another one, it is SOXQ, Invesco, and we do see a double strong buy rating here, so a little bit better than SMH in terms of the rating summary. It is trading again at its 52-week highs there or thereabouts, a yield of 0.64%, but we do see an expense ratio that is lower at 0.19. We do now note it is up 56%. It is lower than SMH. Main reason for this, whilst it does have exposure to Nvidia and it is the largest holding, we do see that percentage is much lower, so the exposure is less there. Very quick analysis of how these ETFs have performed relative to each other. What we can see over the last year, SMH is the leading one. No surprises due to the massive exposure that it does have to Nvidia in comparison to the others. When we do take a look at SOXQ as well, it is the second best there at 57%. When we expand it to over the last 3 years, we do see again SMH 119%, and again SOXQ there the second best performing at 80.18%. As always, if you did enjoy the content, smash that like button, hit that subscribe and bell button. Let us know your thoughts, whether or not you're adding to any of these AI stocks in the semiconductor industry, and whether or not you are also adding ETFs for that full exposure and maybe more of a security. As always, take care, and we'll see you all on the next one.